All right. How's everyone hanging today? This fine Saturday. What's that? 11th of June, 2022. Yeah, it's been a pretty eventful year, and it's hot as hell outside right now. So pretty much everyone's staying home. So I figured, you know what? How about spend some time like making a, I don't know, video? Since I've been trying to get into this making video kind of stuff. About today I'm just going to talk about the market, the regular market, not the fake market, aka Bitcoin. I'm half joking about that, not really serious, so don't take that too hard. So basically, I just wanted to kind of take a look at the market and kind of walk through some of the things that has happened and what might be the possibility and possible situation that we might face in the future. And so, needless to say, I mean, this has been, like I said, like a very eventful year, and based on everything that we've seen, one would expect the market to be also kind of reflect that of the overall kind of situation, everything from domestic, like the most basic things to international things where relationship with the second superpower, the second military power in the world, and possibly still the first nuclear power in the world. We have worse relationship with them than ever, right? Even worse than any time in Cold War. So yeah. So on the back of like BLM and COVID and now this and with all the capitalization of the economy and Fed giving BlackRock and a blank check to buy stuff up, right? I don't know. We've seen a lot of things, and so yeah, I guess like what we're gonna talk about, what I'm gonna talk about, we is how the market is shaping up right now, and again where it might be headed. Before I start, I just want to say this is not an advice. This is not a. I'm not telling you to do any of this stuff. You got to do your own research. This is just me, my thoughts, and myself only. And it's not your thought; it's my thought. You know. Um, and so I'm not. This is not a recommendation. You're better off to um, give basically if you're not someone who involves yourself in the market, you should have someone like trusted, like a financial consultant or advisor, someone like that, to if you want advice. So yeah, I just want to say that. This is for educational purpose, maybe informational, maybe hell of an entertainment. Even if you get that, then I did a good job, I guess, or at least that makes me feel better. Really, half the things make me feel better. That way, like I don't spend too much time on Twitter or any other kind of like social media stuff. So anyway, we're gonna look at the market and kind of figure out where it's at right now. And really, the big question in my mind is that whether the last like counter trend rally that we had from the lows of 38.10 all the way up to 41.85 and a half points or so in SPX. Is that something of a short-term rally, or is that something that it pretends for a more of a maybe major rally going into the end of summer, right? And so, and not to mention, have we seen the end of the bear market? Let's say, right? Was the 38.10 the low? And so to hit it off, what I'm gonna say is that based on everything that we have seen, everything that we know, all the events that has happened, my bias and any trader in the market, they start off with that idea first. What is your bias? And when I look at the market, I'm looking at more longer term period, and the bias is well, it's downside, right? It's we're essentially, in my opinion, again, this is my bias based on my uh, history, experience and knowledge. Um, I mean, I have some experience with both retail and institutional trading, so I think that the bias long term or the intermediate term, the underlying environment of the market is that we're definitely a bear market, if not an outright recession. I believe personally that we are in a recession or recessionary type environment, only to be confirmed by the end of the year by data to come out. However, that doesn't mean that you don't like trade long in the short term. I mean, you can trade whatever you want, and in short term, sometimes you have counter trend rallies. You can even trade long, because the way for example, in like my long term account, something like an IRA account or your 401k, like basically I have more of a different approach, more of an investing approach than a trading account where I'm trading, and so I can go in and out. Especially nowadays, the market's gonna be going down fast. The markets, there's a lot of beta, there's a lot of volatility, so that would mean the market moves up or down real hard. So what that implies is essentially that you can make a killing, or you can get killed in a fast-moving market. So if you're good technically and other ways of tracking the market, well, great. Um, but one thing is that also is a way to figure out that we may be in a bear market, because in a bear market, market moves fast. The market goes down, so the saying goes, the market goes down, takes the elevator to go down, and takes the stair to go up, right? So, um, but so if we start from that, I guess like basis, right? That foundation, then um, my bias is that every time you have these like bounce, right? These counter trend rally over here, kind of a rolling rally, and kind of broke this kind of uh, resistance line over here. Right? You can, if this whole move was just like a pointless, like, or this was just like a um, one step in a bull market, this high that you have here, it should have broken this high, right? The high of the year, but it did not. So that tells you that there was no strength to the market move, and so there was not a lot of strength to the upside. And furthermore, what was worse is that it broke this level, which also is kind of like an important pivot level that it hit two times here. You could almost see a kind of like a I mean, it's not a perfect head and shoulders, but it does. I mean, enough to all I want to look at is I'm also very bare bones in my technical analysis. It's just the pivot where people are congested, where they are congregating, and so the level was important. It broke through, didn't stay, and really the 4200 is now like our main area, or 41670, I believe. And this level is also something that has been hit in the past. Come on, stop it. Let me show you here. Why not Max? Let's go Max. We want everything, all the data. All right, so you can see that right there, right? So you have another level of congestion about 4170 or so. I'm not a Nazi with my technical analysis. Again, all I want to do is look at the main trend, the main momentum, the main strength, the main direction, um, and with some very basic like understanding where the market important levels are at, and what does it imply when you break through, or how the market behaves around those levels, right? And yeah, so basically, this is a very important level, and let me show you like something that I said and on Twitter about like on the 20th of May, and because that was the day when the 20th of May was Friday when we had the low, right? So I'm gonna pat myself on my back. Usually I'm right, but I'm trying to be humble here. But yeah, I mean, I'm not right all the time. But the market looked like essentially it was kind of waiting for a sharp bounce. And so that's exactly what happened, right? The market just boom, boom, moved up. Now, also another technical or like the price action that kind of makes me think that this is a bear market, or another point that you can consider that it's a bear market, is that the way these bounces happen. Um, these bounces are really happening like real fast, and this is what you see in bear market is that you have a sharp downside, then a sharp move up. And on average, though, the thing with that is the up moves doesn't last as long, maybe half the time as the down moves. Um, and so, furthermore, also it's like if you look at the highs of where the high was 4,818, all-time high, right at the start of this bear market, down to the low of the bear market, which is 3810 or so, right, the 20th of May. Um, the That's almost like 1,000 point difference, right? So if usually in bear markets also, whenever you have a rebound, retracement, whatever you call it, a counter trend, what ends up happening is that usually, generally speaking, they move up about 25% of the difference between the latest low and the start of the bear market, or the highest high, right? And so basically what you're looking at is this like secular high of 4818. And so the if you look at 3810 from 4170, that's roughly about 370. No, so it's yeah, 370. 360, my bad. I'm sorry. 360. So at three, basically that's 36%, right? So generally speaking, if it's at 25%, it could go up to how much, like 50%. It does happen, but essentially we just look at probability. So it has run pretty well. And again, the funny thing is that when it broke down last week, it broke down real hard the end of the week. Um, and there were some news that came out, that some of the data that came out, you would think that there was some, generally speaking, better, but market still didn't hold. So again, it goes to show you that uh, even on neutral or maybe slightly positive news, things are not, the market doesn't hold, right? Again, another way to figure out that this is possibly a bear market. And the secular reason I think that long term we have a bear market, if not a recession, is it's all basically interplay between what we price in the market, which is earnings, right? Future earnings, discounting future earnings, and and so that's what shows up in the prices, really, really. And we look at interest rates, and we look at like inflation, things like that, right? The jobs market, right? This is all all these things are based off of. And my main concern is that the market was pricing in early, like last month, what was that, 10th or whatever, early May, when the Fed hiked up the interest rates by about 50 basis points. The market was expecting about 75 basis points, because everyone's taking this inflation rate, inflation really seriously, and it is a serious matter now. But they didn't. Now the problem with that is the idea was that, oh, because they have positive job numbers, which is fair, but the problem with that is that that's based off of earnings that were coming in, and a lot of these things were based off of earnings that were coming in early in the year. But now that we have with with Ukraine stuff, right, it's going to show up in the earnings like as it starts to come out, like the next earnings cycle. So now we're going to see, holy crap, this company's going to make a lot of money because, well, things are more expensive now. There's dislocation in supply chains and logistical chains and all this kind of stuff. And so that's going to be one headwind. Now, that also would mean that jobs numbers will actually start sucking, right? And that becomes important going into the end of the years, because if we have higher inflation, if the Fed is not able to control the inflation with 50 basis points, which they're not, I mean, I'm betting they're not, basically. Maybe you bet different, but I don't think that's the case. Um, oh, my bad. Oh, that's really, really, so anyway, um, so yeah, and so basically my basis is that it's likely that they're not going to be able to fight inflation. If that's the case, they have to jack up the interest rates. And what the market was pricing in early in the year, sorry, early last month, that's something that will take into effect late in the year, which would mean that the equities and like risk on assets will be just basically be dumped, right? Um, and so based off of that, I do think that we have a bear market, a lot more to go. The question is now, does the market just tank from this point out and go down, or does it kind of keep on moving up? Since the early of the year was so bad, it's my bet is that I wouldn't be surprised if we have a summertime like counter trend rally. This is somewhat normal. Whenever something moves this fast, this how fast we had a decline in the market is kind of almost historic in proportion, right? That sometimes you will have really sharp counter moves, and even if it becomes like sustained into the summer, I think these headwinds will still mean that we are going to be in a bear market the next leg, next end of the year. In the summertime, though, it's possible. I mean, we don't know the future. It's possible it can just keep on moving up a little bit. And this happens because, as I say, sell in May, go away, right? People are just having fun. They don't care about the stock market. They went home. And so and so that's possible. And after that, start of the, once we start to get all these numbers, once we have factory orders coming in at the end of summer, because what happens is that everyone gets geared up for the holiday season, people make orders, and if things are bad, energy prices are up, inflation is up, people are not spending money. Guess what? The projection that the manufacturers have and everyone in the supply and the logistical chains have, if they underperform these projections, they're not going to get the type of orders, and that would mean again, less jobs, declining orders, declining, demand, and in other words, that it's not going to be good. That would imply market's going to be heading down again. So it's possible you might see a summer kind of uptrend again, but my bias is to the downside. So if need be, I'm probably going to be fading every rally. I mean, intraday, I mean, it's great if you want to be long, but I'm not trading as much as you used to. So intraday, I mean, you can go either way, but intermediate term, I would think it's these are like you fade these things. So I guess. Let me show. Yeah, I'll just 10 more bars here. Yeah, so if it does move up, this 4170 has been proven to be an important zone, or 4180, whatever, 4175. Again, I'm not really it's really 4170, but I'm not a Nazi here with, I'm not like, stuck in the mud with these kind of things. I think this is just like sometimes people get so amped up in this in technical analysis. It's like it's, like a couple of autists just like reading tea leaves. Um, so yeah, so basically this is going to be an important level. If it does go up and breaks up, then it's possible that we might see a somewhat of a summertime rally and move up. Might move up like this. I mean, it's not going to move it like this. Generally going to go like this. Again, boom, boom. Goes up. Right. If it breaks through this level with some good, solid momentum, great. We probably will have it go up over here, right? If it doesn't, then well, it's proven to be proven the uptrend, the up, the rally has proven to be a failure if it doesn't break this level. And if it does break this level, which is very much possible, look at the momentum. Then we're going to be going back to the same old, downward market again. Um, right? And you can see why this is pivotal, because you have this level and you also have this downward resistance line, and it wasn't able to break through. So now we know this is a very important pivot, the 4170, 4175, whatever, this general area. And so if it does break it, great. If not, we're looking at this level, 3810. If it breaks through, I mean, there's a lot of pain. Summer might be a killer. But anyway, so yeah, that's just kind of like couple of scenarios I was thinking, and maybe make a short video about. I thought it's going to be like a 10-15 minute video, and looks to be 21-minute video. It's not that bad. Um, so so yeah, I'll leave it at that. One caveat is on all this is this is that um, it's important to keep in mind that um, our the bear market till now may have already priced in all the things that are going to happen in the future, right? People are looking into it, and they already prefigured this. Um, Now, that's very much possible, right? We don't know the future. Uh, you make your decisions based off of the bias that you have, based off some reasons. Some of the reasons I kind of went over. If you look at the forward-looking PE in the market, um, what's interesting about that is it's still very, very high. And if the PE ratio goes down something that's normal, unless one thing is that either the equities market have to go, either earnings have to go up, which is kind of hard to see now because with all these problems that we have, um, and that's kind of hard to see. That would mean that essentially we're looking at the price of the equities market and the general price levels of everything to come down. So that's one, and yeah, I guess I'd end of thought. What was that other point I thought I had in my head? Let me think. Ah, dang it. And so yeah, I remember now. Usually when we have a recession, right, it's based off of inventory clearance. Like essentially what ends up happening is that you have a lot of orders, right, that not a lot of inventory that's kind of been made, like backlog, right? And you don't have a lot of demand because, well, I mean, for whatever reason, they're not there. So there could be demand destruction, could be many things. But the point being that usually they're like inventory reduction. And so therefore, if let's say a warehouse is full of stuff, right, they sell that out before they order anything new. And so that would mean that in its chain, in that whole supply chain, like everyone in the value chain, everyone's taking a short-term hit, if not a long-term hit, right? Some business might go bankrupt. Basic, part of your like boom and bust cycle. But what's different nowadays is that everything from, I mean, just think of the last 2 years, the 3 years, right? It's like we live in interesting times, right? So we don't. I mean, it's not just a regular thing that's affecting the market. It's everything, including the war in Ukraine, which our most popular president ever in American history and the best U.S. government that America could master, come up with in 2020 or 2021. These people have been so competent that essentially they made something that didn't have to happen. Not only did they make that happen, like everything from, I mean, I don't know. I don't want to say a lot of these events, starting from like, obviously before then, BLM and all that kind of stuff, COVID and all that. But with the Ukraine stuff, essential they poured like basically that just like light that whole thing on fire, really. And every step that they have taken is so bad, so disastrous that um, it's just can't express in words how bad they have been in everything, like dealing with this, right? So we have a precarious situation in pretty much quote unquote in the economy and the market. On top of that, it was already in a bubble situation, right? Nasdaq was breaking down before January, right, in like late November, and so yeah. So basically, my point is that this is not a usual like environment that we are in, and so that implies that if we have a recession, it's not going to be driven by the usual suspects, so to speak. It will be there are a lot of other different things that are combining, right, conspiring, if you can think like that, behind the scenes. So I'll leave it at that before I keep on rambling on, and I gotta head outside. It's been 20 minutes. I've been on the freaking computer. So that said, I hope you have a great Saturday and happy trading. Yeah, hopefully you guys learned something, got something, got informed or entertained, infotained, whatever the hell they call this. Next time I see you, hopefully you guys made a lot of money and I made a lot more money than you guys too. So thank you. Have a good weekend.